Good afternoon, everyone, and thank you for joining us for another exciting episode of Keeping It Simple with Simplify. Today, we are excited to welcome Charlie McGarraugh, who is Principal and CIO of Altis Partners, for a conversation on commodities and managed futures. And this will be interesting because I think that Harley and Mike might actually agree on the value of adding managed futures into a portfolio. So this will be exciting. So of course, we have Harley Bassman and Michael Green with us. As always, this discussion is meant to be entertaining and informational. It's not meant to be taken as investment advice. And then there's a Q&A button right down there at the bottom of the screen. If you have any questions or comments that you want to submit to the speakers, please do so there, and then we'll try and incorporate them into the conversation. So as we get started here, Olga, will you put up a poll? Let's get a read of the room from the audience. On December 31st of this year, where do you think the price of oil will be as measured by WTI? Is it going to be above $120, between $100 and $120, $80 to $100, or below $80 a barrel? Now, Charlie, you are not allowed to vote. Neither is Harley, Michael, or myself. But let's give it a minute, and then Olga will put up the results, and Mike will get us going.
Look at that.
All right.
Majority thinking it's over $100. So clearly inflation is still top of mind. Commodity inflation is top of mind. And so there is probably nobody better to bring than Charlie McGarraugh. Charlie, welcome to Keeping It Simple.
Hey, thanks a lot. Appreciate it.
So just this very quick background. Charlie and I have known each other for, it's probably about 14 years now. You and I first started interacting when you were head of the metals desk at Goldman Sachs.
That's right.
And back then, those who know me from that time would have recognized me as a certifiable gold bug. You are also favorable to the golden medal, but you've also spent some time in the crypto space, and now you've continued on with your commodity focus in your role at Altis, who is a partner with Simplify on some of our projects.
That's right. I'm currently a Chief Strategy Officer of blockchain.com and involved in crypto world. And I'm also the Chief Investment Officer of Altis Partners, which is a managed futures house.
Fantastic. And yet you and I are still friends. You're involved with crypto and we're still friends. See, the world does have capacity for love in all sorts of ways.
Indeed.
And now we're being joined by Harley, who is a neophyte into the commodity space, having never touched anything other than interest rates, but he's touched that so well this year. So I'm going to have to give him props on it. And what we wanted to do is very quickly give your background, Charlie. You, to my knowledge, you started at Yale University, then you transitioned to, was it Herein at the time or Goldman Sachs?
It was Goldman Sachs. I joined Goldman right out of undergrad, and I was a trader there for 16 years, mostly in credit, emerging markets, corporate credit. I was one of the first default swap traders at Goldman Sachs long ago.
I'd totally forgotten that. That's actually correct. Yeah.
Then, and then I was in the mortgage department in 2008. And then my last job at Goldman was I ran the metals desk from 2013 to 2016. And then I left to become a tech entrepreneur. And and then from 2016 through now, I've been working on electronic trading, machine learning, and digital asset technology.
Fantastic.
Electronic sports betting company that we sold to blockchain.com.
So one of the few that we can definitively say was involved with the Big Short, and now the Big Long, commodities in the in the age of inflation.
Yeah.
All right. So let's talk for a few seconds about the dynamics of commodities and how, ultimately, I think you and I think about them in a very similar way. We prepared a couple of slides that I just wanted to flash up onto the screen. So let's do that. Let's go for the requisite sharing. And
that's with you, right, Mike?
That is with me. I'm going to take responsibility for this. So we're joined, as we said, and then there we go. Okay. So the first thing that I always like to highlight for people is that commodities have a monetary component to them, right? That ultimately what we're talking about, and I use gold for this for the very simple reason it has limited industrial components to it. But there's a question of how many dollars per ounce, or how many dollars per barrel, or how many dollars per bushel, et cetera, that we're constantly looking at. And so there's two sources of change in commodity prices. One is the commodity itself, and the second is the general value of the currency that's being used to peg it against, right? So when we talk about gold on a year-to-date basis, the experience of a Japanese investor has been radically different than the experience of a US dollar investor.
Yep.
If we look at that characteristic, right, this has historically been the one that people would point to and say, this is why commodities over the long haul will rise in price in dollar terms. That it's largely a function of this monetary component to it and the devaluation of the currency that occurs inevitably as a byproduct of either monetary policy interventions, so stepping in to save us from a credit crisis, which is a shortage of money, and so we increase the quantity of money that is available in order to address that shortage, or it could be tied to any number of choices from a fiscal policy standpoint. We're going to, engage in a guns and butter campaign, for example, right, for doing both popularity. The second thing that I always like to highlight to people is that there's an inventory component to it. And the way I try to normalize this, and so remove the monetary component, is by thinking about commodities in gold terms, effectively putting us back onto a gold standard for the purposes of this analysis. And one of the things that we find there is what's called a commodity pinch chart, right, or pinch point chart, or a stock use relationship between prices. And here we see the second type of price change that happens in commodities. Ultimately, commodities have to be rationed in some situations, particularly when you enter into shortage. And the most effective way to do that in the Adam Smith framework is price, right? So as inventories get lower and lower, it basically becomes a game of chicken. Who really wants this commodity? Who's willing to pay the highest premium to take this commodity in? We see that as the clearing price in the market, and it often leaves people in shortage situations. We haven't really seen that yet in oil, which is one of the things that I would highlight for people in the dynamics of oil in particular, is even though the price appears really elevated in dollar terms, in oil, in gold terms, it's really not that far off the floor, right? It's
on this chart, are these weekly or monthly observations?
These are actually weekly observations.
So I think what's really interesting about this chart is like there's two separate clouds, right?
Agree.
And that's kind of interesting because if you think of, especially a commodity like oil, which is sort of hard to store, and it's really like a flow asset. It's not really like a stock asset, right? Or 100% like the total value. It's a supply chain that's in motion, right? What I think is interesting is with these two separate clouds, it's like a market isn't either in surplus or in deficit, right? So if there's too much of something, then the price has to go down enough to either kill supply or induce new demand, right? And then
and that demand can take the form of an expansion of storage, right?
And it can take within whatever the capacity is, or the ability to bring storage capacity online over some time frame. And then if there's just not enough of something, then you can't bring out more supply with price. So the only thing you can do is kill demand with price. So like that leftmost cloud is basically the process of demand destruction, right? Whereas 100%. Like the rightmost cloud is some combination of like supply curtailment and demand inducement, which I think is interesting.
And it's one of the things that I actually think is really interesting about where we sit in that process right now, because we're at effectively that transition. And so this is part of what I think people would point to in the commodity space. And I know a number of people view me as bearish on commodities, which is actually not true. But the underlying characteristics are, we can cause this to transition by addressing the supply components, or we can cause it to transition by addressing the demand components. We can effectively tank industrial production, which seems to be the path that the Federal Reserve wants to pursue.
Yeah.
But that creates conditions under which the price could very easily transition if we come out of a form of recession without having increased supply. One of the biggest concerns that I've spent a lot of time talking to people and educating them about is the risk that we end up on the left side in this.
Yeah, exactly. Steeper, like that orange dot looks like it could think about phase transitioning.
Right? That's exactly my fear.
That doesn't seem like it would be a good thing.
No, that is not a good thing. That is definitely not a good thing.
Yeah, unless
Okay,
you're a producer.
And then the last thing that I would highlight is that there's also effectively a long-term or technology component around commodities. And so this is another chart that kind of highlights, one, this phase transition dynamic, but it also looks at a very, very long-term picture of oil. And you see this for almost any commodity, right? So any industrial commodity has two ways or two metrics under which it can be improved. You can either improve how well you utilize a barrel of oil, for example, or an ounce of, or a ton of steel, right? You could use it more effectively and therefore require less, and therefore it is worth less in many ways. Or you're synthetically increasing supply through substitution. But you can't do that with gold. And this is actually one of the things that I think is so interesting about when people look back at the gold standard and they talk about the deflationary characteristics. The purchasing basket at that time was largely commodities. And so really what you're seeing over that time period is basically this chart, right? You're seeing the fact that gold is always going to be measured in ounces. It doesn't change its utility, or grams if you want to use the metric system. Whereas a barrel of oil can be used more effectively. We can effectively get better product out of the oil, right? We could theoretically improve the way that the end products themselves are used, i.e. higher miles per gallon, for example. And all of those create conditions under which the underlying characteristic of a gold-based standard is declining. What's interesting again here is that we see on this type of metric, oil basically sitting right in the middle of its historical range, right? And again, this is one of the biggest fears that I have is that we transition to the top side of that range. That would be a very bad situation for the economy.
And Mike, does it matter that you could run out of oil theoretically in the long run, whereas gold is gold? I mean, what we have, it never goes away. So it's a permanent asset of a certain size, more or less.
So the history of that, when you run out of something, it ceases to have utility from an industrial standpoint. We figure out a substitute for it, right? So if we truly ran out of oil, yes, the last barrel of oil might be incredibly precious. But the simple reality is that long before that occurred, we would have had to figure out substitutes for oil that would have effectively meant that it was functionally worthless, right? The Mad Max scenario where we cruise the roads, of a barren, dystopia in hopes of finding drops of gasoline seems extremely implausible to me.
I think you're thinking about the notion that the Stone Age did not end because we ran out of stones.
The Stone Age did not end because we ran out of stones. The Bronze Age did not end because we ran out of bronze. We did not stop whaling because we ran out of whales. We discovered a substitute. We depleted the resource, but we ultimately discovered a substitute. And in a terrible way, that's also a broadly misunderstood component. The primary use of whale oil was as a lubricant for industrial machinery, not so much for lighting lamps or anything else. Okay, so with that as background, what I'd love to do is spend a little bit of time talking about how to think about integrating commodities into a portfolio. What are ways that you can use? And so you've got this combination of these three factors: the monetary component that ultimately means it's likely to rise over time, the inventory component that's very tied to the business cycle, and then the long-term trend component that I would argue suggests that there's really very little net return associated with commodities over a very long period of time, right? Certainly not holding it. As a result, we're left with the question, how do we incorporate this asset class into the portfolio? And just as guidelines, I want to make sure that we don't bring in tickers or introduce explicit names to strategies for a very simple reason that I'd like to stay on this side of the compliance line. So with that said, Charlie, why don't you start by telling us what managed futures are and how to think about them in kind of the context of many of the points that we just raised.
Sure. So managed futures are sort of like a niche strategy of the alternative asset world. They have quite a long history, right? The futures markets themselves, I guess, are 100 plus years old. They're one of the most structurally mature markets out there. So very regulated, very burned in, lots and lots of precedent. And they have some really unique features that are pretty interesting from an investing and trading perspective. The first is that the leverage is implicit in the financial instrument as opposed to explicit through borrowing and lending on balance sheet, right? So if Harley and I agree to trade a ton of copper in 3 months' time, we can just shake hands on the price now without putting up the full amount for the transaction, right, on either side. And that, in my case, when I'm selling him copper, I don't have to put a ton of copper sitting there ahead of time, and Harley doesn't have to put the the $8,000 it costs to buy it in escrow. Like, we can just partially escrow that bet and settle up on a net basis. Right?
So let me pause for 1 second just to explain to people the difference between that, right? So when I buy a share of Coca-Cola, and I always use Coca-Cola for simplicity reasons, the only way that I can obtain leverage is by explicitly borrowing in order to buy more shares up front, right? I could enter into a futures-like contract, what's called a contract for difference, right? But at the end of the day, I have to enter into a side agreement. You may have heard us at Simplified talk about ISDAs or the prime brokerage relationships that we rely on to provide that type of leverage. Within a futures contract, all of that leverage is embedded, and at the end of the day, you're for the vast majority of contracts, you're actually settling on a cash difference versus where you entered. There are some markets that are settled physically where you can actually enter into the physical delivery, but that is an exceptionally rare outcome, or at least as a proportion of what's traded, it's an exceptionally rare outcome.
Yeah. So the futures markets are structurally leveraged instead of leveraged on balance sheet. So it's a levered product implicitly. That means, and there's a very sort of mature workflow around that kind of globally between the exchanges and the margining agreements and how the clearing and so forth works. And so the market is very structurally mature, and it's been around a long time. The origination of these markets were, I'd say commodities, trucking and bartering in commodities is basically the second oldest profession in the world.
Mm-hmm.
The Phoenicians were moving this stuff around in boats, back in the day. So it's a time honored thing, right? And
almost certainly, as Guys and Dolls, the musical, will tell us, done in service of the oldest profession. So
no comment on that front, but sure. And then there's a real industrial need for it, right? Because it's capital intensive to make commodities or to build, invest in agriculture or mines or energy production or whatnot. And so in order to stabilize the expected revenue from said production, it makes sense to hedge something. So there is a real industrial need for hedging in commodities. And in order to hedge, right, the risk of the future price movement has to be offset into the market, right? And the markets are full of speculators who are willing to take that risk in order to earn some positive expected return, basically. And so over the long haul, kind of efficient market theory would sort of suggest that maybe there's some excess risk premium to wearing the volatility of commodity prices, and that long dated, and because producers want to sell to stabilize the revenue in order to have a lower cost of capital, there is some positive expected returns to owning commodities just as a function of that risk premium out there. Now, that's a heavily debated sort of academic precept. Everybody can have their own opinion about that, but that is kind of one thought. Now, the managed futures asset class kind of came out of these markets and is sort of like packaging certain methodologies of commodities risk management as an investment product. In other words, if the commodities markets are willing to pay speculators a risk premium for the deployment of their capital, wearing the risk of the commodity market, then perhaps that's investable on a repeated and ongoing basis, right?
So this is one of the things that's come up in internal conversations, and Harley chimed in on this the other day as well, right? I mean, the general idea that futures are a zero-sum game, right? Anytime you enter into a contract and a contract for difference, by definition, there's going to be a winner and there's going to be a loser. The idea is fairly straightforward, that this is just pure rank speculation with no net contribution to human society. In other words, we're not doing God's work here.
Yeah.
But that's not actually true at all, right?
I totally don't think that at all.
Okay.
Yeah.
As a
So
Goldman Sachs
why don't
alum,
I elaborate
explain
on
to
that?
us. Yeah, exactly. Explain
So
to us how you are indeed doing God's work.
Yeah, I can. Well, that's a fairly unfortunate phrase, as my former boss's boss, Lloyd Blankfein, found out about a decade ago. But yes, why don't I riff on that idea for just a second? Okay, so it is true, I guess, in some sense, that financial risk is neither created nor destroyed. Right? It's just is a thing, and then there's some expectation of what an outcome will be, and then an outcome happens, and then somebody makes money and somebody loses money. Right? That is sort of true, I guess. But there can be different folks who are more and less efficient holders of that risk. And it really has to do with what their cost of capital is on the one side. And then also, right, sort of economic theory would sort of suggest that the pricing mechanism, or the sort of the invisible hand, is this incredibly helpful mechanism by which an economy achieves efficiency, allocating its resources. Like price discovery is probably a good thing to steer resources around the economy, right? And so to the extent that more participants with more capital can create a more fulsome picture of price discovery with more liquidity, then the system can allocate resources better, right? Now, in that context, specifically trading futures, right? This kind of gets into trend following, right? Which is like a trend is the process by which a market goes from point A to point B, to state the obvious, right? But why, in price terms, but why would a price move from point A to point B? Well, because the information set has changed, right? But markets are full of participants that react at different time scales, right? If there's news on a stock, for example, all the day traders react right away, right? But investment committees may take weeks or months to change their allocation to a sector or to an individual asset, right? It's similar in futures, in commodities, or futures anything else like financial instruments like bonds or short interest rates or equity indices or whatnot. The trend, the process of the price going from point A to point B is in my opinion nothing more than the process of a market ingesting information and reflecting new information in the price level.
So this is one of the things you said the other day as we were preparing for this call, and I absolutely love this point, and I just want to make sure that we reinforce it because it plays into a bunch of different areas that I'm involved with.
Yeah.
One is this idea of a price transition that is a function of different information sets or changing information sets.
Yeah.
For example, a war in Ukraine, right, changes the likely distribution of wheat on the global stage.
But sorry, it's not even just, it is that for sure, but it's also a single information set that's at parity across all market participants, but the market participants have different wavelengths of reaction function.
Yep.
Right. So the response to the information, even when the information is held by all, could be different for reasons that are not necessarily just profit maximization. Right.
100% agree. And you brought up exactly the idea that I bring up in the passive dynamic, right? So when you think about a passive fund, for example, or a passive allocation, it effectively has zero memory as to what transpired before, right? Whereas a value investor could very well have a super simple algorithm that says, well, the price went up, therefore it's too expensive, therefore I should sell it, right?
Yeah.
That's like the simplest form of mean reversion, et cetera.
Yeah.
In a situation in which the information set has legitimately changed, one of the things that you would expect as the information diffuses out into the market is the mean reversionary players would slowly lose to the mean expansionary or the trend players who are saying, no, this is actually a very different situation, right? So I would look at you and say, you're crazy for buying. You would look at me and say, I'm crazy for selling. And that process slowly creates the trend dynamics that you're referring to. One of the things that causes the blow off top, for example, is me realizing, oh my gosh, I made a mistake. I've gone short. I was so convinced of my mean reversionary views, and now I have to buy it under distressed conditions.
For sure. I think that's actually a really good point, which is a trend is in part, right, information at parity and everybody reacting rationally just on different time scales within the constraints of whatever their organization is.
Yep.
Right. But there's also a behavioral component potentially to it as well, which is like people sell winners and ride losers just as a behavioral human phenomena, right? And so the blowout leg of the trend is like basically the stop out on the riding the losers. And so you end up with this sort of like fight the tape, fight the tape, fight the tape as the profit taking happens. And then the second wave is like, oh my gosh, I can't have this anymore.
Right.
Right. And so I think there are, there's all these behaviors or, things that are, I guess, intrinsic to the market structure in terms of the segmentation of its participants and how much voting power they have in terms of liquid capital to deploy on the margin. Right. And then like the upshot of that is, statistically speaking, autocorrelation in the time series of prices, to kind of use a mathy term, but persistence.
Yep.
It just as a sort of phenomena is like statistically a thing, right? And I think it's really interesting when, I used to run a number of different sell side desks at a big investment bank, right? And we would see the trend followers come in sometimes and be like, as a market maker, you kind of roll your eyes. It's like, oh, here they are buying the top. It's always inconvenient because like whatever everybody else wanted to do, the trend follower also wants to do. And so as a market maker with your inventory, they always make you shorter or longer when you don't want to be, right? It's not great. So I always kind of roll my eyes and be like, well, these guys are the anti-value traders and they're net taking liquidity out of the system, right? But I don't think that anymore. Not that I spent a lot of time studying it. Now I'm like, they're actually adding liquidity to the system because they're accelerating the process of price discovery to the efficient level reflected by the information set. In other words, when you look at the movement in the market, recognizing statistically speaking, again, we never speak in absolutes, we speak just in fans of probabilities, right?
Mm-hmm.
But statistically speaking, the motion in the market, not just the level, but the first derivative and the second derivative, the motion in the market is saying something predictive about where the price is going. In my opinion, better that it gets there faster.
Charlie, can I zip in here? You made a comment I want to zero in on about the risk premium in futures.
Yeah.
I know in option trading, implied vols trade traditionally 8 to 12% over realized. So if you play the insurance game long enough and size it right, you'll make money on that. Where's the risk premium in futures? Is backwardation?
Yeah, it's just like the backwardation may be, there may be some back-ended lower price, like you can buy the future production lower than you would otherwise be able to buy it because somebody needs to sell it.
But isn't backwardation just really the gross cost of capital? Like in interest rate futures, it's very simple what the number is.
Yeah.
I know what the coupon is and what the forward is. I can arbitrage it out. I mean, is it the same thing in gold and oil where the price cost of inventory?
I think that's a really good question, but again, when you sort of say like, okay, the slope of the curve is just, we can apply some interest rate and in the case of commodities, a storage cost as well associated with that. That sort of assumes that everybody in the market has the same cost of capital and that there's just this sort of like infinitely leverageable borrowing market that everybody can access. And that's really not the case, right? Like if I'm going to go build a giant, oil project in the North Sea, I may have a totally different cost of borrowing than if I'm going to go and build a giant oil project in Nigeria.
Usually the largest player tries that. But I want to get back to what is the risk premium? What are you extracting by your skill?
Well, a couple things. One is in the curve shape, like I said, like backdated contracts should just be lower in order, people are selling production at a discount to stabilize revenue in order to get a lower cost of capital for equity and debt to build projects, right? That's one thing. And then, so that just would argue for a long bias in commodities, like in general, right? And then secondly, maybe more, I think much more importantly, right, is this idea that there's persistence in the movement of prices, right? And that not everybody who, again, in the short run, the market is a voting machine. And in the long run, the market is a weighing machine, right? Momentum and value, right? But also the process of reflecting value requires momentum to get there, right? And so the market has historically through the years provided excess returns for, to people who are willing to bet on the trend, right? And at some kind of really basic dumb level, it kind of makes sense, right? Just like we've all been traders in the market for a long time, right? Like there's kind of nothing new under the sun to some degree in liquid markets, right? You have basically positioning of who else is sitting at the poker table and how big is their stack, right? And what are their behavior patterns and incentives, right? Valuation and momentum, right? And
So,
when you look at that momentum component, right, like most managed future strategies are about betting on the momentum over different time horizons as measured across multiple time horizons. And there's lots of quantity work that can be done around sort of saying like, oh, short-term momentum versus long-term momentum. Maybe it's different to the top side than it is to the downside, and we should condition this and should try to think really thoughtfully about the times it works and the times it doesn't work and all these things, right? But just on the whole, trend following, statistically speaking, over a period of many decades has embedded excess returns. Right.
So this is one of the things that I think is really interesting, because when you talk about the premium associated with futures, there's actually there's a number of different signals that I would argue you can extract, right? One is this difference in cost of capital. As we've known since time immemorial, bankers have a lower cost of capital than farmers do for the most part.
For sure.
Right. And so one of the things that's being done is the transfer of risk in terms of the future price of that commodity to those who have more capacity to deal with the risk of ruin, don't have the operational risks associated with it. And it's one of the primary reasons for the flourishing of the exchanges is that it removes some of the particular execution risk or operational risk associated with a small farmer who might want to commit to delivering X number of bushels of corn some point off into the future, or X number of head of cattle.
Sure.
So that's one very clear point. The other is exactly as we've seen recently. You enter into periods in which there are relative shortages across the curve. And I should probably point out that the chart that I showed earlier on the oil gold ratio is using a 1-year gold strip. For example, in the last 2 years, we've seen a situation in which oil traded to negative $37 a barrel, right? That was a very clear indication of, if you could actually deliver storage, or you were willing to take the legal risk of storing a highly toxic product in unapproved warehouses or unapproved storage facilities, you were going to receive a significant premium associated with that, right? So that's another source of return that could have been derived.
Yeah.
The shape of the curve captures that. We see some that trade with contango. For example, gold has very low storage costs, and we're effectively paying people by allowing them to sell it off into the future while their storage costs are relatively low. But things like oil have fairly significant storage costs. We have to incentivize people to be willing to store that oil under normal conditions, right, by selling it to them more cheaply in the future. And that, as Charlie points out, also helps the management and the operational process of an oil company, for example. They get stability of revenue that they otherwise would not have in their planning process.
Yeah, and then there's a bounded aspect to the storage capacity as well, which is it's just physically finite. Gold, you can store infinite, like the value density of gold is extremely high, so the storage cost is extremely low. But for things like oil or, God forbid, water, right?
Yep.
The value density is much lower, and therefore the storage capacity may be, more challenging.
It would actually, that's a fascinating point. I can only imagine what the dynamics of backwardation would be in the water market.
Yeah, well, that's a topic for another day, but obviously,
yeah, that's a really interesting one. No, it is very near and dear to Charlie's heart.
Yeah.
Okay, so now everything that you've heard us talk about so far is effectively the mechanical process or the logic process that goes into constructing a managed futures strategy, right? You're trying to think about each of these individual components and put on the hat of what you would do if you were a trader, but put that into machine language.
Well, sorry, I would actually even take one step back, which is,
sure,
we talked a bit about why there might be some excess returns to be had in these markets. Right, in general, why it's not just a zero-sum game. It's like risk is moving to the efficient places. There's a lot of complexity around storage. There's differences in cost of capital and market structure, right? But so it's probably not a zero-sum game because risk should flow from inefficient to efficient holders, and it's hard to manage because these products are levered and complicated, right? So there's probably some excess premium on offer to the extent you have the ability to do that, right? But there's also another piece to it, which is, even if it is a zero-sum game, because there are many zero-sum games out there, like baseball or poker, right? It doesn't mean it's an uninteresting problem to figure out how to do a good job at playing the game, right? Right. And what I would just say is the futures markets have a lot of volume, and they're reasonably efficient at moving a large amount of risk around, right? And so, in fact, they're probably the most efficient locus of price discovery for a large number of assets, including various financial assets that do trade, physically, like stocks and bonds, right? Bond futures are a big thing. Front-end interest rate futures are a big thing, right? So the futures markets, because they are so burned in and so mature, and you're able to move so much VAR with such a high degree of efficiency, right? They kind of abstract away a lot of the other things that come in with trading and asset management over the counter markets, right? And really get you focused on like two things. One is prediction and forecasting, and the other is risk management and portfolio construction, which are part and parcel of the same thing. Right?
And you bring up a really good point there, just very quickly. I mean, while we're talking about commodities, we're not talking, oil has thousands of different flavors of it, right? Light, sweet, sour, etc. But at the end of the day, we can construct some form of converting that into an energy content component. And what we don't have from oil is the equivalent of an earnings report in which there is idiosyncratic issues associated with a single company or with a single entity. And so the prediction becomes very, very different. It's not about what is Apple going to do or even what is ExxonMobil going to do. It's very much what are they going to be doing in aggregate, right?
Yeah, it's like what's the income statement of like the entire supply chain as opposed to the balance sheet of an entity within the supply chain.
I think that's wonderful to think about. And so this is one of the reasons why it becomes a crucible for what we were talking about before. When we think about an inflationary condition, not that there has been inflation, Harley, I'm joking about that. But when you think about an inflationary condition, it does actually orient us back to these questions of what is the monetary component, right? So commodities as an asset class can catch a bid in these periods of monetary debasement, uncertainty as to future policy, et cetera. We've very clearly seen that, but then they also have characteristics tied to the mean reversion and the demand destruction that you so eloquently pointed out effectively on that left cloud, right? That environment in which we're just not certain what's actually happening now. So when we did this, when we set this session up and we called it WTH is up with WTI, right? It actually had an F in there before compliance got to it. But when we think about what is actually going on with oil or what is going on with commodities right now, where do you come out in this mix? Do you see this as primarily a monetary phenomenon, or is this primarily an inventory phenomenon at this point?
That's a really good question. I think to answer that question, the short answer is I'm not sure, and it's a bit of both. But there's a complex interplay between them.
Okay.
Right? Like when you think about the global financial crisis of 2008,
that
was clearly like a financialized balance sheet recession. Right.
Absolutely.
Like balance sheets were over levered. There was interlocking credit problem. And then, basically the lender of last resort had to intervene to fix balance sheets. And then the world was over levered and everything had to either restructure, reflate, or grow its income statement to get out. Right.
And it's often very hard. I mean, you were sitting on the desks at the time, as was Harley, but it's often very hard for people to remember that in the middle of 2008, the discussion was almost identical, right? The Fed is trapped. The Fed can't respond because inflation is beginning to run hot. Commodity prices are rising. We actually entered into a pause in the cutting cycle precisely tied to that. And that narrative was very hard to break.
For sure. So but that was in the end a balance sheet recession fueled by basically an over-levered overhang of debt that caused a massive deflationary problem, right? When COVID hit, right? COVID wasn't really like a financial construct. It was more of like an income statement, like not really a balance sheet problem. It was like an income statement problem. It's like the supply chain is screwed up. Entire modalities of how people like get along and do stuff, not just the accounting of it, between debt and equity, but literally like what are people actually doing in terms of their physical activity mix and workflows and processes. And anything that was long and had like a big dependency graph of kind of this is what it takes to get the job done was at more risk of disruption than anything that was short and robust, right? And that was COVID, right? And then that kind of turned into, well, guess what? Like the only tool we really have to deal with this, other than a bit of, directed industrial policy intervention in things like vaccine manufacturing, which was a massive win, right? It was basically like, well, let's just use the same balance sheet tools we have, right? And then we created like an epic asset inflation of the first order. Crypto was last in and more recently first out, but benefited massively, as did the stock market and every other asset, right? Commodities kind of came along for that ride. But now, because of the inflation, real assets are super interesting, and commodities are basically a way to invest in the supply chain, or a way to invest in the income statement, including through that monetary component, right? And catch that hard asset inflation upstream in the factors of production, right? And so like, yes, commodities are an awesome inflation hedge for sure. They're probably better than art and real estate because they're liquid. And that was the other point I kind of wanted to make, which is like, even if it is a zero-sum game, right? And I emphatically do not think it is, particularly if there's monetary debasement, right? Because like, the zero sum's only in the numerator, but the denominator keeps inflating, and that's a different animal, right? But what I was going to say is, like, even if it is a zero sum game, we're living in a world of like profound change, right? Institutional integrity is in question up and down the stack, whether it's the coherence of the international geopolitical order, whether it's the length of a heavily optimized supply chain from China to America in one direction, and for molecules, and from America to the rest of the world for IP, like however these supply chains are, they're long, they're complicated, and they're in a state of flux, right? And in a world that's undergoing like tectonic change, persistent tectonic change, trend following should do well, because trend following makes money when a change happens, and then instead of being anesthetized with an intervention from the powers on high, the change becomes more and persists. Right? That's when trend following works. It's like when small changes turn into big changes and don't come back. Right?
I think that's a wonderful description of it, right? Because what we're actually seeing is uncertainty in all three aspects of that phenomenon, right? We genuinely don't know what is the underlying story with the monetary situation. If the Fed chooses to continue to tighten, the risks are extremely high that we enter into something that looks more like a credit crisis, right? The shortage of capital that's available to repay debt causes us to question many of the things that we did in 2008.
Agree.
That could lead to catastrophic declines in commodity prices, but the second part of it, the uncertainty around the x-axis and that inventory chart, right? What does industrial production look like? What does inventory look like? Look at
and what does forward capex into capacity look like?
100%, right.
The other, which is also related to the balance sheet aspect, which is the cost of capital.
Absolutely correct.
Yeah.
And then the last component is that, even within the context of that very long-term picture of oil deflating against gold, we may have screwed up in an energy transition, right? We put too much emphasis on renewables, things like solar, wind, et cetera, that we really cannot actually currently substitute, particularly many of the transportation and high energy content fuels, right?
We may not be able to substitute fast enough, right? Like that's sort of the risk, and for sure, there's an undercapacitization in that, which will induce a change faster, but also probably with more price volatility. What I was going to say is, in the futures markets, which, like I said, are really, really, really mature and burned in, if your job is to trade that stuff, you're abstracting away as much institutional uncertainty as you can. You're like, I'm going to focus on an institution that's 100+ years old, and that kind of everybody uses, and nobody questions. Sorry, not entirely, since I used to run a desk full of gold bugs, but most people don't question the integrity of the futures markets, right? Yep. And so like, it's a pretty burn-in thing, which means you can focus on just like being dynamic and moving a lot of risk around really fast and really cheap from a friction cost perspective. And so in an environment that's likely to reward adaptive behavior in the context of large tectonic, fundamentally unpredictable but persistent change, it's probably better to be in the asset moving business than in the storage business. And when we think about like the last 40 years of financial investing, like passive investing or the 60-40 portfolio or whatnot, right? Like basically, if you bet on financial asset inflation, you did pretty well, because interest rates came down over a long period of time, and that ended up working out really great for both bonds and equities, right? That whole and because the Fed basically intervened to persist the asset inflation trend, bonds and equities had this negative correlation through the Fed reaction function, and that was great for everybody, right? Like that whole thing is different now. right? It's not obvious to me whether the Fed is working for capital or labor or something else, or maybe just the Fed, for example. It's also even less obvious to me that the central bank is the prime causal agent in the market in general. Like the narrative that pertains mostly in the market overall, and you can still see it in back-end inflation expectations even now, is that central banks move and everybody else says, how high should I jump, right? And you can see that because back-end, TIPS break-evens and inflation swaps have been pretty not volatile, right? Like the front-end inflation's all over the place, but back-end people are like, yeah, it's anything, right? Which is
this
central
is
bank causal, credibility, right?
well, and this is one of the Harley's most famous points, right? Tips, right? We're not supposed to trust that data. But it is a legitimate point, right? That we are seeing very different signals from the long-term uncertainty in commodity markets, whether it's the shape of the curves that have shifted dramatically, or it's a question about the future construction of the supply curves, and the relatively calm manner in which the forward inflation expectations market has not been unseated yet.
Especially in the back end, right? It's saying like the monetary regime is expected to be more or less stable. It is still credible, right? And that's great. And I hope they're right. Sorry, what's that?
I want to go and dig in on where the rubber meets the road. This is an investment show.
Yep.
So, and Mike, I will try to go to the line but not cross over. So Charlie, no tickers, no strategies, no that nonsense. But our very good friend Chris Cole has described what he calls the dragon portfolio, and a fifth of the portfolio he says should be in commodities. Could you tell us how a commodities type strategy, maybe one that we're familiar with, how would that fit into a portfolio? What problems is it solving? What additions are you getting to it away from the ordinary, 60-40 stuff? Like where's the value proposition that a very bright guy has proposed to us?
Well, I'm not going to sell the Dragon portfolio per se, because I don't know Chris, but I have read about it, and it does sort of make sense to me, which is like, as I recall, it's like 20%.
About commodities. We got a Dragon portfolio. I want you to talk about commodities, how they fit.
Yeah, well, I think it's really two things. The first is that trend is not correlated in a stationary way with other risk factors, in particular, like just equities risk premium. Right, so it's just not that correlated to the S&P. Like if you look at the SocGen trend index against the S&P, it's not that correlated, right? That's trend, not necessarily commodities, just trend in general, right? So I think that's kind of one thing, and it's sort of like it kind of makes sense, right? Like if a regime is stable, stability is good for the economic cycle. People build up leverage in stable regimes, assets inflate, right? And then when things change, and then they change more and don't come back, like you want something that makes money when all those other things aren't making money, right? And that's what trend does, because it can benefit both on the long side and the short side, but it's like your long change, not long volatility, which is different, because volatility can be high vol and still mean reverting. I mean, your long actual change, right? So I think that's kind of one thing.
And I would I'm sorry, Charlie, let me just emphasize that, because I do think you hit on a really important distinction. So Chris, in his description of the Dragon portfolio, would largely lump together long volatility, right, and long commodities. And they are often thought of in the same way for exactly the reasons that you're highlighting, the change component to them. But they actually aren't, right? So commodities are not necessarily long volatility, and in some ways don't do well in extraordinarily highly volatile environments.
Like look at oil during COVID. Right?
Correct. Right. They lose the capacity to finance and inventory. Future prices can collapse under those scenarios, right?
Sure.
But this is actually a very different component. This is saying this is long, a different type of uncertainty. Instead of the financial market definition of volatility, this is fundamental uncertainty.
Yeah, I think that's a really good point. It's like things actually change, and then they're different for real, right?
Right.
Which is a mode that's hard for us to think through, because since the financial crisis, kind of nothing's changed. Like everything's gotten a little bit more unequal, and basically stuff. And actually, that's another interesting thing. Like, and I think it's actually get there in a second. Let me finish on the commodities thing first.
Sure.
On commodities, right? Then there's this other aspect, which is it's a hard asset, and it's a thin funnel, right? Because the size of global financial asset markets, like bonds and stocks, or real estate, the biggest of them all, are huge relative to the commodity market, right? Because the commodities market is basically a supply chain that needs to be financially intermediated in terms of some financing, and needs to be financially intermediated in terms of risk management, right? And there's just not as much there, right? And there's only so much inflation hedge that exists out there, like that's investable in the form of gold and copper inventories and stuff like that, because it's not that easy to store a lot of these commodities, right? So being in the moving business and charging the risk premium associated with that, right, should be pretty geared to the inflation factor, and like that is the inflation factor is not good, for other things. Like people say it could potentially be good for equities, but it's not good for equities, not really, because it's bad for earnings, right? So I think it's just a diversifier, and it has this like critical aspect, which is it makes you money when other things are losing money, and that's like the most important thing from a long-term compounded wealth creation aspect. Right, and then there's just sort of this other aspect of all these things, which I wanted to add on, which is like trend is not the only component that's useful in futures to trade, right? Like when you look at the futures markets, again, it's this really mature place where you can move a lot of risk around really like efficiently, while abstracting away most of the uncertainty that pertains in a lot of other kinds of alternative asset strategies. And liquid alternatives allow you, number one, to benefit from being short, because it's easy to be short futures, not just long, right? And that's very different than most financial asset and alternative investment schemes, because if you're in private equity or infrastructure or art or real estate, whatever it is, these so-called alternative assets, they're all still just long because you own stuff. And if the discount yield on whatever cash flows they're going to create goes down, they're worth more money, right? So this asset, like this liquid alt of investing effectively in the income statement of the economy instead of in the balance sheet of the economy, is not as related. In fact, it should make more money when the cost of capital goes up, unlike basically every other financial asset, because you're charged more.
It's a great point, and again, that can be thought of as a forward collapse in the price, right? So if you buy it in the future, you'll yield higher today. I also just think it's worth hitting on exactly this issue of these are ultimately tiny assets, right? So the U.S. consumes somewhere in the neighborhood of, I believe, 12.5 billion bushels of corn a year.
Yeah.
At today's prices, that's roughly $100 billion out of a $20 trillion GDP, right? So we're talking infinitesimally small amounts for the nutritional content that basically sustains all of us, when we include the components of animal feed and everything else, right? So we're talking tiny sums of money, and when financial assets flow, when we talk about things like 20% of a portfolio, et cetera, for the most part, that's really not feasible at today's prices. And it highlights some of the disconnect that's occurred in some of these other areas, right? Like that's my only knock against the Dragon portfolio dynamic, is that not everybody can do it, right? For the various reasons of climate.
Your portfolio, I'll be long dead by this, so I don't care. Certainly,
Yeah.
let's close the loop over here. If such a strategy existed for commodities and you put in 10%, which is probably a fair number, for someone who's running this portfolio, is having an IQ actually valuable? And I'm being very serious here, because I don't think you want to have an opinion. I think if there's really a risk premium to be drawn out of it, it should be an algorithmic for value or algorithmic for trend. And you having an opinion actually is a negative. Am I right or wrong on this?
So I think that's a really good question. So let me rephrase that question in a slightly higher IQ way, if you'll pardon the pun, right? Which is, when you're identifying a factor that has returns associated with it, right? Is it sensible to attempt to time your deployment into that factor, right? Or to blend it with other factors, right? And I think the answer to that is yes, right? You can add value, right? Like it's not every day is momentum season, right? For example, momentum and trend following did terribly in like the mid 2010s because the markets were anesthetized with QE, and like all the risk premium associated with intermediating the flow was basically front run by the central bank with their excess liquidity. By the way, that's going in reverse now, which should mean that, it's an even better time to allocate to these factors now. That's an opinion, right, to have on the market. That's a market opinion, right? So you're just having an opinion about something other than like, hey, the price of this share should be higher, the price of that commodity should be lower. It's something other than a directional opinion. It's what kinds of behaviors are likely to be there. So I think that's one thing. It's still possible to have opinions and just deploy into factors. The second thing is, when you're trading this stuff, as important as trend is, and it's super important, it's not the only factor that matters, right? And so like another thing to try to figure out is like, when does trend work and when doesn't it work? And as I said kind of before, there's nothing new under the sun. It's like positioning, momentum, but also valuation, right? And like the thing we always saw when the CTAs would come in as a sell side guy was like, oh, here they are buying the top, here they are selling the bottom. And like, we kind of would feel that when it felt like the value proposition of the trades they were putting on was really asymmetric the wrong way. Like, why would you want to sell a distressed subprime mortgage bond at 5 cents on the dollar when it can go up 95 cents and only go down 5, right? Even if the trend is a really strong signal that is going lower, right? So at the end, value matters too, right? So I think there is a component to this, which is like trying to understand how to blend other factors in and how to think about the interplay between these things. And that's a pretty high IQ exercise. So we do that in a lot of our strategies. Like we think about valuation and how valuation matters in systematic macro trading in addition to trends. Yeah. So I think, yeah. So again, one IQ thing you could do is when does trend matter? And then another one would be like, what other things matter and how do I blend it in?
And so this actually was a question that was fielded from the audience. The question was, when we think about a commodity strategy as embodied in something like the Dragon portfolio, it has to have the ability to go both long and short, right? It can't just be a long commodity expression, because then the only thing that you're capturing is effectively that monetary component, right? So if we go back to the 3 factors that I highlighted, we have this question of, is there a monetary component? Is there, I would describe value components as effectively the second 2 charts, right? Where it fits in an inventory cycle and where it fits in terms of a longer term utility cycle.
Yeah.
We're going to have to wrap up, and I hate doing it because this is such a deep and rich area. But I wanted to give you a little, both a nod and a little bit of a tweak with the opportunity to talk for just a few seconds. You've said repeatedly that there's nothing new in commodity land, and yet there's Bitcoin. Can you talk for just a few seconds about how Bitcoin would fit into a commodity portfolio?
For sure. Bitcoin trends a lot, for starters. So there's a huge amount of autocorrelation in the time series. Secondly, Bitcoin is not structurally mature in terms of its penetration of its total addressable market, or Ethereum or other assets, right?
Mm-hmm.
So digital assets, I think, are still a big question mark about like their ultimate. They're still an experiment, right? Like their ultimate use cases. It's very tempting to think of them as tradable widgets, like a commodity or an FX or an equity, but they are more that they are that, but they're not just that. They're also technological toolkits by which the very market structure can be transformed to be more peer-to-peer, more self-custodied, more asset-based rather than institutionally based. And so all those things, could induce different behaviors and certainly induce different measurement frequencies and timelines. Like it might not be sensible to take like a trend following system that's calibrated on oil and use it to try to predict Bitcoin trends. Like maybe the crypto market just moves faster because it has a different kind of class of character with a faster reaction function than the oil markets, right? So I think that the amount that which they're like retail versus institutional, like all these things matter a lot in terms of just like the behavioral characteristics of the market. That said, it has a lot of idiosyncratic variance, and the more uncorrelated volatility there is in anything, it will be beneficial to add it in to the extent that the same statistically predictable phenomenon occur, right? Because you can diversify your bets and extract more signal.
Yeah,
so we do have, for example, CME futures in crypto in some of our strategies on the regulated future side.
So I love that, and that's exactly where I wanted to end on this, right? Which is the way that I think many of my friends in the commodity world see Bitcoin is not from a standpoint of certainty, right? The fact that it exists, that it's been validated by CME futures, or that Ethereum has similar characteristics, but really it is this dynamic of the kind of voyage of discovery. We don't know what it is, but it has some characteristics that make it, very tradable as a financial asset, right? And so to me, it's interesting because nothing that you said would validate my position for or against, but you are highlighting that it's eminently tradable. And so
I would just add one other very specific thing to build on that. I know we're out of time, which is the degree to which it acts like a macro asset consistent with macro narratives, like high correlation to NASDAQ periodically, and then doesn't, right? Like even those phase transitions are extremely tradable and interesting, right? So like just as a student of just markets, they're like a very, very interesting thing to be involved with.
Fantastic. Charlie, thank you so much for joining us. We're thrilled to be working with you. And honestly, like there's nobody that I would rather have on my team in terms of the commodity market. So thank you for joining us with Altis and spending the time with us in the dog days of summer where even Harley is hanging out in the Hamptons. With that, we're going to let Brian wrap it up for us.
Thank you, guys. This is really great, and thank you to our audience for joining us today. I love that Mike and Harley didn't even yell at each other once. I mean, this is like I think this is a record.
We'll yell offline.
Yeah, exactly. So this upcoming Tuesday, we're going to be hosting a market update with Mike Green and our co-founder and CEO, Paul Kim. If you're interested in joining us, please contact us at simplify.us. And then for more information on Altis Partners, please visit altispartners.com. And then next month, we're going to welcome Harley's chum and former Merrill colleague, David Rosenberg, for what I'm sure will be a very upbeat conversation in the economy. So more on our website, September 8th, same bat channel, same bat time. But thank you everyone for joining us, and have a great evening.